right, guys, we're going to go ahead and get started. Appreciate everyone for joining our QE to QT current market recommendations webinar. We've got quite a bit of material here to cover, so we're just going to jump right into it. My name is Phil Rasori. I'm COO of MCT, and we've got Andrew Rhodes, who's our head trader, and Paul Yarbrough, who heads up our client success group and our deployment of MCT Live. Really, the reason we wanted to do this webinar right now was, as we came through last week and then into this week, in just the continued fairly relentless move up in rates and the volatility that's been associated with it. Wanted to go through that, kind of go through some recommendations that we've been telling our clients, and kind of push those out to the industry as we had done a couple of years ago. But also, with September 14th being the last day that the Fed made purchases of MBS, really kind of go through really a brief history of QE, because it's pretty striking when you go look at it and you put it into the context of 9 days ago them making their last purchase, and based on everything that we're all hearing in the market, that we're all seeing, really not, doesn't look like there's any any turning around there in the near future. And so some of the statements that we're going to talk about the balance sheet, spread to treasuries, mortgage spread to treasuries, and kind of what we see that doing given how much MBS is on the balance sheet, and what the Fed is indicating, how much they want to hold, or more specifically not hold on their balance sheet. So we'll start with, again, we normally in our webinars, we're normally laser focused on a more tactical recommendations with hedge pipeline hedge management, loan sale execution. But we're going to start with a year-to-date overview and then go into a little bit of QE. But bear with me, we'll definitely bring it through to today. That'll be the first third, and then Andrew is gonna talk about kind of where we are coupon and liquidity. This has plagued us obviously all year as we've continually transitioned coupon to coupon to coupon. Literally starting at a 2.5 to 3 coupon, and now, after when it looked like when we were down today, although we've bounced back a little bit, we're flirting now with upwards to a 6 coupon. So with bid offer spreads and liquidity on those new coupons, it's consistently both from a premium perspective and just a cost of trading perspective, it's continuously been an issue throughout the year. And then we're going to move to some trade extra recommendations, some loan sale execution recommendations, and then Paul's going to review some software tools that can be used to help with manage some of the volatility and the liquidity issues that we're seeing. So just moving right into the historic kind of the year-to-date performance that we've seen on treasuries. Obviously, it's been a liftoff. I just want to speak to a couple kind of key points. We've if you look in the first couple months of the year, we've just slowly drifted upwards in rate. The 10-year treasuries in white, 2-year treasuries in gold there. And slowly drift up. That was obviously from starting in November and December, those surprise upside CPI releases. Then you continually had you remember that month after month, it was highest CPI since 1980 or 1982. And so that was the first couple months, and then basically the first drop in rates that we saw in the year was February 24th. Of course, the invasion of Ukraine. That only lasted. Go figure. A war in Europe only gives rates about 10 days, because then in beginning of March, you had just a blockbuster non-farm payroll number and a CPI surprise to the upside in March, and then again in April. So that's really when the true 2022 liftoff began. And then the start of the summer in May kind of leveled off, and then if you remember, on June 10th, we had a substantial CPI surprise to the upside, and that of course created a little bit of a panic in the market on the 10th and 13th, and then the Fed really established credibility on the 15th, at their 15th meeting, June 15th. If you remember that, they inserted that they're strongly committed to 2%. The market began to believe them, and then really we saw a little bit of a drop in rates, and then back to in basically beginning of July, a strong non-farm payroll number, so strong economy, but additionally, another blowout CPI number of 9.1%. That puts us really inverts the yield curve, and we'll talk about that more here in the future. Then we have a strong August non-farm payroll number, September's surprise to the upside CPI release of August CPI numbers, and really the rest is history. That really brings us to today, where we've got just continuing rise in rates. You can see I've got in this graph, really as of a couple days ago, we had the 10-year around 410. I believe today it's been bouncing around, but we were up to 420. And then a widening inversion of the yield curve. So 10-year around 370, getting closer to 50 basis points on the yield curve inversion. So obviously a huge rise in rates, but of course that's only part of the story, right? Of what's happened to us here in the mortgage industry. And really this really is key to tying in the performance that we've seen on mortgage rates and the Fed, frankly. So we're yesterday we had the Freddie primary mortgage market survey at 6.29%. Obviously, we're probably a little bit higher today. So that's up just over 300 basis points in rate from their first reading of 2022 on January 6th. If you compare that, of course, to Treasury yields, and most of you guys know this, where Treasury yields are up, but they're only up about 200 basis points, a little less than 200 basis points. And so what's happened is, when you put that in perspective, that we're up call it 310 basis points in mortgage rate, but Treasury yields, benchmark Treasury yields, are only up less than 200 basis points. A full 35%, over a third of the increase in mortgage rates, is due to the blowout that we've seen on the mortgage spread to Treasuries. So that's, of course, mortgage, secondary mortgage rates, the price that the market, basically the increased yield that's commanded by investors over and above the Treasury rate. So that started out the year at in the mid 50s, and now we're seeing, as of today, I think we're probably over 170 basis points. So there's been literally a triple. We've tripled that mortgage spread. So Andrew will talk a little bit about, again, this is a quintessential textbook example of a year where you did not want to hedge with treasuries. So we'll talk about that in a little bit in the future here. But we're gonna come back to this slide because it's problematic from a standpoint of where we are now in terms of the Fed's balance sheet. So now, but first, if we can go back to just kind of looking at basically the history of QE, I think again, there's been a real changing of the guard here. That's the way we see it. For those of you guys that a lot of you on the call here have been in the industry through 2007, 2008. It's I think it's important to go back and look at what the Fed did to support the market, but also, not just support the market and kind of also work to draw down the positions through the first 11 years of quantitative easing, and then what happened during COVID. But basically, the initial launch of QE was November 25th, 2008, and initially was 500 billion. It was expanded to 1.125 trillion on March 18th, 2009, and then that basically those purchases went right through March 31st of 2010. And if you can remember that far back, the purchases basically stopped at that point, and they were just reinvesting. And as you can see from the balance sheet here, although they had announced in late 2010 QE2, that was just from a Treasury perspective, right? So we were actually still bleeding off mortgage MBS on the Fed balance sheet. So the Fed was buying less than was they were reinvesting less of their proceeds from the prepayments of these mortgages, or the payoffs of these mortgages. So you can see that the balance sheet then went down under 900 billion, basically for the next 2 years, and brought us to September 13th of 2012 when QE3 is announced, and that's when we shoot up basically from 900 billion to basically the position, the high that kind of got us to the high water mark of 1.7 trillion in basically by October 29th of 2014. So that's the kind of the conclusion. And so at that point, the Fed just continues to reinvest the proceeds. It keeps the level at 1.7 trillion on the balance sheet. And everything from a standpoint of mortgages, obviously during this period of 2014 through 2017, we had a lot of stuff go on. We had elections that there was concerns of changes in immigration, changes in in trade policy that would potentially cause inflationary effects. But from a standpoint of the balance sheet, we were pretty much at a level position. And then in middle of 2017, the Fed announced their balance sheet normalization, and this is the real success as it pertains to the Fed bleeding off the balance sheet of MBS. So going from 1.7 trillion down to 1.37 trillion over just under 3 years. And in doing so, the mortgage spreads to treasuries held. We were at about 80 basis points during this period. And so when we say spreads to treasuries, that's again mortgage yields over and above treasury yields. And so that basically takes us down to basically, we're going further and further down in balance sheet size here, and hits us right into March of 2020. And so you can see, and it's this last part of the graph here, and this is nothing earth-shattering, nothing new that most of you don't know, but it's good to look at it in perspective of the entire almost 14-year period of quantitative easing, what went on. So we were down in, again, we got down from a high of 1.7 trillion in, through the 2014 through 2017. Balance sheet normalization brought us down to 1.37 trillion. And then during the period of March to June, of when the Fed launched that cannon to support the market. And again, we're not blaming the Fed here, obviously, no one is, because they had to come in. There was cracks in the MBS market. It was trading like a risk asset. They had to come in and support it. But that 600 billion that they bought in 3 months, you can see not only took, basically it basically rose, the balance sheet in 3 months, double what had been drawn down in 33 months. And so that was a steep rise, but of course the period that will go down in history as the period of where the Fed overheated the market was the next 17 months between June 2020 and October 2021, where they just continually clock over at 40 billion a month of additional purchases. Again, this is not total purchases. Total purchases peaked over 130 billion in middle of 2021. This is just additional balance sheet, and so that's why you see that continual rise there. And so now that brings us to basically to 2022. So they begin to very slightly in October 21, slightly taper their asset purchases, and that's net asset purchases. So they're still, they're still in the close to 100 billion in total purchases, but they're tapering from the 40 billion in ads per month at this point. And kind of the first shot across the bow, again, we're specifically to balance sheet. The first shot across the bow is on January 26th, where they outline their plan for eventually, reducing MBS on the balance sheet, and they state, and it's really just frankly a historical reaffirmation, to hold primarily Treasury securities on the balance sheet. Now that's a big statement when 2.5 trillion at this point sit on the balance sheet, right? And we have done nothing but, for the last 13 years at this point, 13 years exactly, on January 26th, the Fed had done nothing but basically support the market, and then they're basically saying at that point that 2.5 trillion have to come off the balance sheet and eventually flood back into the market. So again, just for everybody who's not in this every day, that's more supply that is priced down, yield up, right? All things being equal, and so really that brings us to the start of the summer, when they announced the balance sheet reduction plan. And at that point, the balance sheet is at its high water mark of 2.72 trillion. And that really takes us to really to last week, where the MBS purchases conclude. And I think that you can see the issue, and what we're going to be dealing with here, specific to our market. So the reason I say that is when you see Bloomberg and you see CNBC, and they're talking about treasuries, obviously that discount rate of future earnings from dividends, or how they discount growth on the equity markets. Those rate rises are obviously hitting the equity markets, right? We're seeing that this week. You're going to potentially continue to see that. Who knows where treasury rates will go from here? That will command the headlines. But it's important to realize that separately from that, completely separately, completely potentially disconnected, is the spread to treasuries and the resulting mortgage rates, because of what we have sitting on the balance sheet. And again, we have 2.72 trillion. So we've added, from the start of COVID, we've basically doubled the balance sheet. And they had gotten down again basically to 1.37 trillion, so almost exactly doubled. And now we have a Fed that, just because of the market, not that any of us would probably disagree with the Fed at this point, but because of the market, we have a Fed sitting here saying that they do not want to hold hold MBS, right? So what's happening now is that, as you get refinances, as you get amortized payments, those are just not reinvested. So you will naturally see that come down. The big question, of course, is, does the Fed think that that's fast enough, right? The question is, will the Fed begin to sell MBS? I think a lot of us don't foresee that, especially as you see mortgage spreads widen out. But it is important to realize that is a potential. But I think that again, where you look, going back to, and I won't go back all the way through the slides, but going back to our spread to treasuries slide, if you see that sitting right now in the 170 basis point range, we started the year at 56 basis points. That kind of makes sense, right? Because we were at the start of the year, the Fed is not only reinvesting everything that is paying off into the balance sheet, they're additionally buying $40 billion a month at that point. What's a little bit more alarming is that at the beginning of COVID, this is pre-COVID, at the end of 2019, spreads to treasuries were at 80 basis points, and that's when our balance sheet was slowly running down over a period of years, and we only have 1.37 trillion. Now we've got a lot more potentially hitting the market. So I think obviously we don't make predictions about the future, but all things being equal, with the buyer not, the primary buyer not in the market, and the statement that they want to continue to draw down that balance sheet of MBS, without any changes, all things being equal, I think we would call for that spread to treasuries to continue to widen. And I think that's important to realize that that's regardless of what happens in the mortgage, in the treasury market. That's specific to mortgages. Now, just turning it over now to Andrew, and we'll get into the bulk of our presentation here and some tactical recommendations. This is what the problem that spread to treasuries causes is this, like I said at the outset of this call, this continued transition upward, coupon to coupon, and basically giving us liquidity issues as we break into these new coupons. Literally right now, almost on a monthly, if not weekly basis. And so, Andrew, I'm going to turn it over to you, and you can give us some recommendations and just what you guys are seeing from the trade desk.
Yeah. Well, thanks, Bill, and definitely gives you a good perspective of kind of the Fed intervention in the market. And I don't know why this didn't really come to mind previously, but the whole balance sheet normalization in 2014, to 2019, it's interesting because sitting at 1.3 1.3 trillion on the book, rates were, I think there was more refi incentive for the majority of the market, at that point in time than where we're at right now with the market. So I do think it's going to be just given that, I think it's going to be a slow bleed off for that portfolio. But like Phil says, I don't think anybody's talking about them selling, but that is a potential concern for everybody. But just to kind of hop into the slide, I don't think this takes anybody by surprise. We were initially back on at the beginning of the year. We were looking at a weighted average locked note rate flowing into the open pipelines right around 3 3/8. And as of the time we pulled this, I think a couple of days ago, we were sitting just over 6%. So huge increase in rates for the year so far, and that's definitely that upward trajectory has definitely caused some issues in regards to liquidity, and I'm sure everybody's seen premium, also another issue of just hard to find, and it's really tough to find in these kind of moves. So I think that does take me to my next slide. This first bullet point was also done a couple days ago. So the 5.5 has actually been, currently it's at par for the front month. So stuff that we're just gonna have to continue to keep track of where the market's at, where the market's moving. I grabbed these volume numbers to kind of show exactly how everything's been trading and where it's been trending. So the fact that we're seeing the 5.5 teeter means that we are going to be moving up into that 6% coupon. But as you could see with this graph, there's really not a lot of production in those higher coupons. So we're gonna have an issue with liquidity as we move up into those higher note rates. So what we're finding is that there is potential to cross hedge with the more liquid coupons as we see the kind of interest rates rise, or as interest rates kind of continue to increase. So we're waiting for what essentially what we're doing with cross hedging is we're waiting for liquidity in those higher coupons, and what comes along with that, and what I'm looking at specifically, is the roll cost on those higher coupons. So going up the stack, you could see a huge increase in the roll cost between the 4.5, 5, and 5.5. So as soon as we get up, start looking at the 6 as a coupon, we want to make sure that we're understanding the risk that we're taking on by pricing out to those higher note rates, and then also if we are going to be putting on those higher coupons, that we're looking at our exit strategy on those. And exit strategy for those illiquid securities would be assignment of trade, or if you're doing MBS securitizations, you're able to trade those securities on swap to make sure that you're mitigating your bid-ask exposure and not having to take that full market cost into account. The reason I wanted to put the market movement on at the bottom of this is just to show the difference between the 4.5, 5, and 5.5. As you can see, they're all kind of moving in the same direction. But over this period of time, you had the 5.5s that were close to 103, and this is over the last I think over the last month, so going back to August 22nd, and now that's currently trading right at right at par. So you know, a substantial drop off in the last couple weeks. And I think a lot of that is you know, just the market concern. I think we did see a nice little drop after the CPI number came out, because I think that pushed everybody's expectations of the Fed to go ahead and, you know, go to a 75 basis point hike or a 100 basis point hike. And then, you know, I think with the Fed announcement on Wednesday, you know, coming out and just being more aggressive in what they're looking at for the terminal rate for the year, I think that did kind of surprise some people. And I think the reaction that we've had since then, you know, has made sense. So today, I'm happy to see that we're trading sideways essentially, but we did have a substantial drop off yesterday. Phil, if we want to go to the next slide. So this goes to kind of the points that I was talking about in terms of cross hedging. You just got to make sure you're looking at your entire open pipeline, looking at all the loans coming in, and making sure that it makes sense to you know, to make sure that you're covering your interest rate exposure on that production. So if you are looking to price in those higher note rates, bring those into the open pipeline, you know, you want to make sure that you're having some additional margin on those note rates, just given the bid-ask spread and the illiquidity on those coupons. So that's what I kind of mean by kind of maintain a dynamic hedge strategy. You want to make sure that you're looking at the front-end pricing for all these loans flowing into the open pipeline to make sure that you're mitigating your risk and covering your exposure on those note rates. There's other ways to do this. Down at the bottom, I say, you know, you could take out some cash forwards. The limiting factor with the cash forwards is, you know, you want to look at all the production that you're delivering to the agencies on a retained basis, and then, you know, pull through, adjust that, and then you could use that as your kind of forward hedges for your cash. So if you are, you know, executing to co-issue execution, then that makes it a little bit harder to use those cash forwards, but it is something that you could utilize, and that does, you know, help out with the cash flow fluctuations during volatile times. I think AOTs are, you know, a huge strategy for us. You know, we've done a ton of work in making that process as efficient as possible. You know, we were just on the line the other day with the aggregator, and says, you know, he loves working with us just because of the efficiency and the efficient process that we have with the assignments. So we want to continue to push that. You know, we're working with more and more investors on opening up the assignment of trade, and this goes back to what I was talking about earlier in kind of mitigating that bid-ask spread by doing the assignments or, you know, taking out that cash forward. You know, we're looking for ways to minimize the overall cost to the client. So I mean, one thing that I was taking a look at the other day was just, okay, how has the AOT profile changed from the beginning of the year to right now? And we have seen an uptick. We've seen about a 35% increase in assignments for our clients. I think we're looking at 72% of our clients are using AOTs in some fashion, and you know, we have some clients that are using AOTs for, I think I calculated one client was using assignments for about 84% of their overall production. So that right there just means that they're able to remove that whole bid-ask spread cost from the scenario, and they're limiting their exposure to market cost when they're looking to go for a pair off on those kind of illiquid coupons. So I think on average, you know, our clients are looking to they're assigning about 37% of their production, and that's on a year-to-date basis. So, you know, we're still getting a lot of adoption in assignments, and we want to continue to push that, because at the end of the day, it is a cost savings to all lenders. So Phil, let's hop on to the next slide here. Another another thing that we're keeping an eye on is the spread of where trades are being executed. So this right here did a quick look back for the year, and these are in ticks. So you can see, at some points in the market, there were some pretty wide spreads between what we were seeing from dealers and what we were seeing from on the screens. And then I think another interesting fact on this is, there are times where we've seen, from multiple dealers, we've seen range of 5 or 6 ticks between the lowest and the highest bids. So ensuring that you're putting bids out to multiple dealers is also a way to look at kind of maximizing your profitability and reducing your overall cost. So definitely something that the traders are looking at in terms of where putting the trades on, is making sure that they're able to utilize the functionality to get multiple bids back on these trades to help them achieve the best price possible. So I think if we want to move on to the next tab, Phil. So this right here are just some year-to-date monthly volume pickups from the AOT side. The spread right here is based off the average year-to-date. So taking the difference between the bid and the ask on the day that the trade was assigned, and then doing an average over the year, and just coming up with these spreads. So we talk, and I'm sure you guys see it on the Ginny side, even on the Fannie side right now. I mean, we're looking at on the 5.5s, we're looking at a 4-tick bid ask. So market coupon on a UM30 5.5 is at 4 ticks. Usually the UM30 securities are traded a lot tighter, right? So you're usually looking at a tick. But I think this goes back to what Phil was talking about with the Fed exiting all purchases as of September 14th. I think as we continue to see volatility in this market, we're also going to continue to see the bid-ask spreads a little bit wider than what we're used to, and I think that's just a function of liquidity. And the Fed, for the majority of the time that I've worked in this industry, has been in the market. So the fact that they're finally taking a step back and getting out, I think it is something that we're keeping a close eye on, and making sure that we're trying to mitigate as much as possible. So once again, any way that you could figure out how to reduce that bid-ask spread, given either using loan sales and new production as an effective hedge, assigning that production, trading that, doing those trades on swap with your MBS securities. Those are all ways to mitigate that bid-ask spread, and limit your exposure, market exposure, on the offer side for those illiquid coupons. So yeah,
Andrew, we've had a lot of questions come in, but and we'll, if we don't get to them all, we'll definitely email you back after the webinar. Logan did ask a question pertinent to this, just on the do the dealers get, with this dramatic increase in assignment of trades, are the dealers frustrated by it? And one thing the reason I wanted to cut in here, and Andrew, you can comment on this as well, is want to make sure we're not suggesting that when you see that Ginny spread of 10 basis points average for the year, and God knows what it is on the 5.5s today. Andrew, did you say what did you say it was on the at Ginny's?
The Ginny 5.5s, I mean, it's come in a little bit, but we're looking at 5 ticks right now.
Okay, so 15 basis points. We're not suggesting that the dealers are gouging you guys, for you as lenders, for this spread. This is not the dealers. I just want to make sure everybody understands that on the call. This is a function of an inefficient market where the friction cost, the price that you can execute a sale at versus a buy at, has blown out, and that translates to the dealer side as well. So we're not suggesting that the dealers have blown out their spreads. And to your question, Logan, they definitely, I think they understand. A lot of them understand that when it comes to if inefficiencies of this level, that we're trying to, everybody needs to reduce those bid offer spreads as much as possible.
Yeah, no, it is a great question though. And yeah, I mean, it really is kind of just a function of the markets, truthfully, that we're trying to, trying to reduce as much as possible with the assignments. And I think the production flowing over to the dealers, they're still able to see the production come through on their side. So assignments haven't been an issue as of yet, and I don't foresee them as being an issue into the future. But with that, I'll hand it over to Paul to kind of walk through some of these other last slides.
Oh, thanks, Andrew, Phil. Awesome information here. We'll get into some of our tools available here to help mitigate these things and show you how we can effectively process these AOTs that we talked about so much. This first bullet point here, I mean, I think everybody knows this right now, especially we don't have the luxuries of the blown out margins we saw in 2020 and 2021, and right now being so thin, every basis point counts. I can't say anything more obvious, right? Especially right now. I mean, in all environments, but when basis points are in the single digits sometimes for some lenders, and it really does count. So how do you get that? How do you achieve that? How do you maximize those basis points? Well, you need to diversify your execution outlets. 4 or 5 years ago, we saw in BAM marketplace, we saw an average of about 16 aggregators per MCT client. Today, that's grown to 21. So what does that mean though? 21, that's a big increase, because we see clients in there with 30 executions in their best X analysis. And so that does sound overwhelming, sounds daunting, all the approvals, all the ways to deliver, but it really does help you maximize those basis points. And remember, with that 30, you're also including probably some agency executions with S&P, which brings me to my next point here. At MCT, we have a great platform to show you, hey, these are other executions that are out there via co-issue, via our BAM marketplace, that you could see some extra pickup. So you really leverage those iMarket reports that we produce, a BI platform that shows these dashboards of where these extra, these other investors that you may not be approved with could get you some of those basis points there. Back in 2020, Phil brought along the idea of this BAM marketplace, where we could execute to investors, great investors that have an execution available that maybe you're not quite approved with yet, but gives you the opportunity to hit their bids, or at least do a live shadow. A little more teeth in it than just your typical historical shadow. This is executable if you want it to be, and so that BAM marketplace is really a great tool to see investors that you may not be approved with, and you can again test and actually commit with unapproved investors, and then move on to a regular correspondent relationship. More to come on that BAM marketplace functionality, other types of executions coming there too. So. And again, just reiterating, just finding those extra outlets to sell loans, non-traditional outlets, and leveraging those diverse methods like MBS, like your AOTs, trading on swap, all those type of executions. So and then Andrew brought it up perfectly here. That UM35 is at a 4-tick bid-ask spread right now, and in our example here we have that 4 ticks. Remember, 4 ticks equals about 12.5 basis points or an eighth. That's $1,250 on $1 million. So that's if every $1 million you assign just in the UM35, that bid-ask spread stays where it is right now, it's $1,200 that you bring into the bottom line. So it just really brings home the point of it's good to do that, and it is honestly a responsibility to maximize that potential by doing those AOTs. This just kind of goes into our BAM marketplace and where we see some pickup here. When you're comparing some aggregators execution to some other BAM marketplace types, when you get into those illiquid situations, you'll have some higher pass through on things like higher note rates, or you'll see here in a second some of the specs that you'll see a bigger pass through. So listen, here you can see above 7%, although may not be hedgeable necessarily, but you can see there's a big pickup there of almost a point, or over almost 2 points in those above 7 note rates. But let's take a look at the more traditional note rates in there. You can see there can be a pickup in these BAM marketplace investors. So just being in MCT Live and opting into that, you'll be able to kind of leverage these executions. And so this heat map here kind of shows you what we were seeing in Q3 so far, where we can see just a good pickup. Just even if you look at those 5.5 to 6, you get a little 19 basis points that we see there. So good liquidity can be achieved by getting approved through other outlets there. So moving on to, and just one more heat map here, just to kind of broaden that out to explode where these pickups can be achieved. Lower FICO scores, right? That you may have as we chase less loans. We kind of tend to open up the credit buckets, and so we need to make sure that we're achieving maximum potential there. Make sure we have enough outlets, and that we can maximize the gain on those. Maximizing gain, perhaps hedging them and selling mandatory, but you want to make sure you have good outlets to sell mandatory. So you can see here those lower credit buckets really get into those BAM marketplace. And what the top right matrix is showing us there, it's really showing you that there could be potential for higher pass-through on some of these the lower specs there. So it's always good to again, just reiterating, by diversifying your executions, you can really maximize that potential, bring more to the bottom line for the company there. Let's go to the next slide there, Phil. Okay, obviously, if you're going to do all this, you're going to execute these AOTs. Andrew said 84% on one client. That's a heck of a lot of paperwork. If you take it back to the direct trade days when you had to fill out a tri-party and then communicate back to your trade blotter which trades you assigned and how much you assigned, making sure you got all that correct. That's a lot of paperwork. So if you're with our BAM marketplace and MCT Live, our AOT processing is really simple, guys. As you execute and request those commitments, this screen on the left side here, most MCT clients that have been on the call now have seen this, but you can see how easy it is. What it is in that BAM AOT available trade section, that's showing my live trade blotter, meaning it's the TBAs I have on right now. That section on the top of that is really just kind of breaking down where what the investor has suggested the coupons that I can assign. And then that bottom box there is just showing, okay, this is what I want to assign. I'm going to hit that confirm assign button, and my commitment request plus my AOT processing is finished. meaning I've filled out a tri-party, I filled out any kind of workbooks that the investors require, and I've lifted that trade from my coverage. Really just speeding along the AOT process makes it hard not to do. And given the pickup that you see, it again makes it hard not to do. Even with the pickup you see, you should do it anyway, but this makes it even easier. So, and then over here on the right, what we've done in MCT Live is it's important to differentiate that execution that provides or has an AOT versus one that doesn't, right? So if you've got investor A doesn't do an AOT, investor B does, applying that spread back into their bid. So again, you get a pickup if you do an AOT, right? So you get that bid-ask spread put back into the bid. That you should incentivize that investor, and therefore showing in your best X analysis, hey, I would like to commit to this, or you should commit to this because of the advantage of assigning versus not. Same kind of concept as including your investor fees, right? You back off the 300, the 500, whatever, how many ever dollars they charge you to sell that loan to them. Same kind of concept. We're converting that into basis points, backing it off their bid. This is just a little more nuanced in the sense that we got to take a current market TBA price and that spread between the bid and ask, throw in any kind of dealer spread there that you typically get charged, and then those are basis points you can put back into that bid there. All right, let's go to this slide here. With execution's important, but also maintaining that pipeline, managing that pipeline. Some more tools that we help do that. Pipeline deltas, more than ever, we got to stay on top of these things. DTIs are probably a bigger issue these days than we'd like them to be. You get higher note rates of DTIs, those can affect your pricing, your eligibility. Credit scores, obviously, if we're, you can see in that second box there, we had a loan that went from a 719 credit score to a 658. Staying on top of these. This is something everybody should always have been doing, just like you should always maximize every basis point. But today it's especially important when, you know, a move like that can take a loan from profitable to not profitable if we don't catch it before the lock is done. Non-owner, owner occupied, that's an obvious one, right? Big price hit there. So expiration reports over there on the right, that expiration report, like, obvious stuff here, but is the loan going to close? How long has it been sitting in a particular status? That's that status stagnation there at the bottom. If the loan's not going to close, if it's stagnating in the earlier statuses, do we need to get that out? Recognize those hedge gains, avoid any hedge costs. Then let's do it. And these tools can help with that, right? All right, this last slide here for me. So it's important to know that BAM Marketplace is a standalone product, as well as it comes with obviously our flagship hedge product, the best in class here with MCT Live. But if you find yourself wanting to explore these BAM opportunities, please hit us up. We can stand these up by themselves. And then how do you use that with your AOT? Well, great news, we can plug TAM in there as well, so you can have a trade blotter that's available to you with some great execution from the broker-dealer community out there. So you can execute those AOTs efficiently within our BAM system. You can look at BAM Marketplace, that's available to you. And then remember that we're also integrated with all major platforms, right? So pushing back commitment data to your database of record, looking at live agency pricing like from Fannie and Freddie, and again with TAM coming from Agile, having your live trade blotter in there that you knew you achieved the best execution from. All that can be stood up by itself, but also with MCT Live as well. So, okay, Phil, that's all I had. Thanks. I'll throw it back to you there.
Well, thank you, Paul, and thank you, Andrew. The great presentations. No, just to close out here, I think that what Andrew and Paul went over as far as how MCT helps our clients handle this volatility is really also preparing for the potential that we could see a period of volatility on the mortgage side, on the MBS side, which may or may not be somewhat independent of the Treasury side. And that, of course, is what we were talking about at the outset with regards to the balance sheet and the Fed's plans for the balance sheet. And now that for the first time in almost 14 years, we don't have the Fed as a participant at all in the MBS markets. So I think that the point here is, if you guys, for any of you that don't currently have some of these things set up, on the hedge side, being able to take advantage of multiple executions on an electronic platform on the bid side for TBAs, that's essential. And then even more essential as we go into a day like today, where we're moving into 5.5 coupons, we're moving into 6 coupons. If you're when you actually sell your loans, to the extent that you have a very wide bid offer spread, it can be almost essential to assign that trade. And I would say that it's so essential that we have clients that will commit the vast majority of their production to cash window executions at the agencies. But in a period like this, they will toggle back over and assign trades. One of the things we talked specifically about execution, but I would also be remiss not to say that assignments of trades can help in a rising rate environment on the cash side as well. We've talked about this in previous client webinars, where everybody thinks of assignment of trade as saving lenders in the period of dramatic rallies, where there's large amounts owed on either margin or settlements to the broker dealer. And a case in point would be like March of 2020. But it's also the other direction. If you're selling loans like right now, and a total gain on sale of 99 or 98, you're wiring money as you're closing and getting those loans purchased. You have these beautiful settlements that are sitting at the broker dealer, potentially 30 and 45 days out in some cases. The assignment of trade is you can bring that cash forward from the settlement into the loan, into the basis for your loan price. So with that, I know we're over time. We will be doing some future industry webinars as the market continues to move. We'll also be doing a webinar on BAM Co, which is our BAM for co-issue, which we're really excited about, and that's rolling out to clients specifically in the next week here. So really appreciate everybody's time, and we will be back to you guys with future webinars. Thank you.